All right, the income statement, what this does is it actually summarizes a firm's financial performance or results over a given period of time. So contrary to the balance sheet, which obviously is a specific point in time, income statements usually are a broader range. And so usually they can be done on a quarterly basis. That's not uncommon. And it's also not uncommon to be done on an annual basis as well. And so they give you a snapshot, if you will, over how the firm performed over a specific period of time, which is generally helpful if you're trying to compare companies that are in the same industry, or you're trying to compare performance of the same company but different time periods to see maybe some type of trend if you're doing some type of fundamental analysis related to the company's performance. And so an income statement is generally built around three categories. First, you have your revenues, which is essentially money that's brought in to the company. And then you have expenses. Expenses are money that is flowing out of the company. It's obviously being paid either to maybe credit that you have that's due, maybe to employees, marketing expenses, anything that you're essentially paying out of the company. It's not money flowing in, but going out. Now what's left is what we often refer to as net income. And this can also be referred to as your bottom line. So a very, very important indicator. After all your expenses are paid, what do you have left? Ideally, this would be positive, right? And then you can in turn decide to either keep that and reinvest it back in the company, use it for research and development, use it for purchasing equipment, giving your employees raises, whatever it is that you decide, or you can essentially pay it out to shareholders in terms of a dividend if you're structured that particular way. Either way, though, it's the money that you have that you decide what you can do with. So all companies strive to have a positive net income, bottom line, profit. Those terms are often used interchangeably, but they mean the same things. All right, now the last financial statement I want to go over here is what we would call the statement of cash flows. All right, the statement of cash flows is good for giving investors an idea over how a company both acquires and spends its cash. It's important to know in a company setting where the cash is coming from. If it's coming in from a particular source, what is that source? If it's being spent somewhere, it's always helpful to know where, because cash is an important asset, one of the most important assets that you can possibly have, because anything other than that you cannot spend necessarily. Cash is tangible. You can do something with it. You can put it to work for you. But if you don't understand where it's coming from and where it's going, that's going to affect your ability to plan for the future. And so the statement of cash flows gives you an idea over what are the sources, right? Where does it come from? And also where is it being spent? And it breaks those down in a couple of different areas. The first one that we have is what's called operating cash flow. Operating cash flow is cash that comes in or goes out of the company based upon the sale of goods and services. So this is, of course, usually a business's primary operations, right? They're designed to sell or offer some type of good or service. And if you generate, right, more money than you spend in that particular area, that produces positive cash flow related to operating cash flow. And so usually what you do is you add in, there's 3 areas total, and we add in the results of those 3 areas, and that determines whether there was a cash inflow for that quarter or year or some type of cash outflow. Now the next type of, or category I should say, of cash is what we call investing cash flow. And investing cash flow is cash that's either received or spent related to fixed assets or maybe even financial assets that are going to be held for a long period of time. So obviously things like stocks, bonds, those types of things, as long as they're not going to be bought and sold with a very short period of time. So that could also constitute investing cash flow. And so if you're spending money on things like equipment or new plants and facilities, that obviously will represent cash that's leaving your particular company. So that would be an outflow. But if you sell property that you have, or if you receive some type of interest or dividends related to financial assets that you hold, that represents a cash inflow. So once again, you kind of summarize and add up each of the different expenditures and inflows, and you come to either a positive or a negative number. And the last one is what we call financing cash flow. And financing cash flow is cash that's either received or spent from issuing additional shares or taking some type of long-term loan. And so this can go one of two ways. Companies can issue additional shares in the open market, which would mean that they are essentially receiving cash, right? That's money that investors are spending. It's going into the company, so that would represent an inflow. Or if they feel like their stock possibly is undervalued, they can institute a buyback, and where they purchase shares from the open market. Thus, that's a cash expenditure. It's an outflow, but obviously they're reducing the number of shares they have outstanding, which is good. Also, with regards to loans, if a company takes a loan, of course, that's money that's being put into the organization. If they pay back long-term loans, then that's money that is leaving the organization. So one of these individually isn't inherently bad, right? There are some quarters where many companies do have a negative cash flow, but you really have to look at the underlying kind of cause of that, right? Are they investing in long-term things like production facilities? Are they acquiring property to expand? Right? Those things aren't necessarily bad. So I wouldn't jump to the conclusion that a negative cash flow for a quarter is a bad thing. You simply have to determine what is the reason for it. And now, hopefully, after understanding the different categories and how the statement of cash flows is broken up, you'll be able to figure out really what the reason is. So that should give you just a general overview of some of the basic elements of these financial statements. What we'll do is subsequent videos will be recorded related to each one individually, and then we'll walk through an actual balance sheet, an actual income statement, an actual statement of cash flows, so you can get a feel for how they're set up and really what are the possible line item expenditures.